Heya Cryptozens. Tonight's show, FDIC serves cease and desist to FTX. Bored apes in danger, and bank CEO would limit stablecoins to banks. It's 10 p.m. Pacific time. The date is August 19th, 2022. Welcome back to the Crypto Overnighter. My name is Nikodemus, and I'll be your host. The cover model, mascot, and co-host for this podcast is Tex. And together we take a nightly look at the crypto, NFT, and metaverse space and the industry that surrounds it. And keep in mind, nothing in this show should ever be considered financial advice. The Federal Deposit Insurance Corporation, or FDIC, started a letter writing campaign recently. They sent out 5 cease and desist letters. These went to 5 different companies that the FDIC believes are making false representations. They're allegedly claiming deposit insurance related to cryptocurrencies. Now, these letters went out on Thursday. They went to one crypto exchange, FTX, and 4 websites, Smart Assets, FDIC Crypto, Crypto News, and CryptoSec. These letters call the companies out for allegedly misleading the public about cryptocurrency-related products being covered by FDIC insurance. And so it came to pass that the FDIC issued a Friday press release about these letters. They said, quote, "These representations are false or misleading." So the representations that they're alleging include things like certain crypto-related products are FDIC insured, or they allegedly said, quote, "Stocks held in brokerage accounts are FDIC insured." And so the FDIC is mad about this. They sent the companies a letter and they said that they must take immediate corrective action to address these false or misleading statements. That's a quote. They want all the bad info corrected on their websites and social media accounts. In a since deleted tweet, FTX U.S. President Brett Harrison was talking about direct deposits from employers to FTX. He said those deposits would be stored in FDIC-insured bank accounts. Now, this isn't the first time the subject of FDIC insurance has come up related to crypto. Remember Voyager? They set up a cash fund to repay cash customers on the exchange if something happened. This fund was set up at the Metropolitan Bank, and there was a lot of confusion around this for some folks. Now, allegedly, Voyager misled people into thinking that their cash in crypto was covered under FDIC, which of course it's not. FDIC exists to repay in case a bank goes under, not the customer. If the customer goes bankrupt, the bank doesn't care other than to close out their account and collect any money due. So the FDIC has had to speak up about the subject of insurance coverage for non-banks in the recent past. Back in July, they issued a notice to the banks in the U.S. They said banks need to assess and manage risks with any third-party relationships dealing with crypto service providers. Now, we covered it on this show at the time. The FDIC said it was important for banks to monitor their crypto partners to make sure they're not passing out bad info, exactly as FTX is accused of here today. Now, recently it's been reported that the government is taking a look at the FDIC. They're considering whether the FDIC is too harsh when it comes to digital assets. They themselves face accusations. In this case, they're accused of discouraging banks from dealing with crypto service providers. We were talking about this the other night. Senator Pat Toomey from Pennsylvania, he sits on the Senate Banking Committee. He sent a letter of his own to Martin Gruenberg. Now, Gruenberg is the FDIC director, acting chairman. In that letter, he tells Gruenberg he's getting allegations made by a whistleblower. And based on those allegations, Toomey suspects the FDIC, quote, may be improperly taking action to deter banks from doing business with lawful cryptocurrency-related companies. At the time of writing, the global crypto market cap is $1.01 trillion. It's down 8.84% in 24. The top 5 cryptos by market cap are Bitcoin down 10.12%. Ouch. Ethereum down 12.79%. Tether, USDC, and Binance Coin down 6.45%. There are apes in danger. Dozens of them. And some punks too, but mostly apes. There are apes in danger and their owners put them there. So what's going on? BendDAO is a lending service. They offer loans based on collateral. In this case, you can offer an NFT as a collateral for a loan. You can get up to 30 to 40% of the floor price as the loan. Now, if the floor price falls too close to the amount borrowed, you've got issues and you could lose your ape. And that's what's happening here. Many owners of Bored Ape Yacht Club NFTs have put them up as collateral to take loans out in Ethereum. The problem is that many of them have so far failed to pay back their loans. Now, we're possibly setting up for the first NFT tidal wave of liquidations. As it stands, BendDAO could end up liquidating up to $55 million worth of NFTs. And they select which NFTs to liquidate based on what they're calling a health factor. Now, here's what this means. Like I said, they offer you 30 to 40% of your NFT's floor price. That's how much you can take out. And as long as the floor price stays above the amount that you borrowed, you're good. If the floor price drops close to the amount that you borrowed, that's when bad things happen. You get a 48-hour liquidation notice. That means to avoid liquidation, you have to repay the loan. Now, this is different from crypto. Because if you deposit crypto as collateral for a loan, and the value of your collateral drops below the value of the loan, you can add more crypto to your collateral to balance things out and avoid liquidation. The non-fungible nature of NFTs means you can't do that. You can't just add another Bored Ape Yacht Club 4326 to the one that you've put down as collateral. There's only one. So you have to either pay up or you lose your collateral. 48 hours after liquidation, and people can start bidding on your ape. Well, the floor price of a Bored Ape went from over 150 ETH in May to just under 70 ETH now. That's a 55% drop. That means there are a lot of people out there watching the health factor on their loan drop and having to make a choice. Right now, there are 20 apes on the edge. So those 20 go up for auction, right? No problem. Wrong. There is a problem. What happens when someone saturates the market by dumping a bunch of Bitcoin for sale? The price of Bitcoin goes down. And I think that the same thing might happen with these apes. But now there's a twist, because while you may get a good deal by bidding on one, you're not going to buy it super cheap and sell it fast. Because when you place your bid, it has to be within 95% or more of the floor price. Now, what should worry anyone about holding one of these collection pieces is this. What happens if nobody bids? Well, for one thing, BendDAO better start worrying about that very thing. Because if nobody bids and buys, then they get no money. They have to wait for the loan to get repaid, if it gets repaid, or wait for the market to recover enough and people are more in more of a buying mood. Until then, they would just have to sit on a temporary floating loss. The global NFT market cap is down 13.78%. Sales volume is down 9.3% in 24. According to CoinMarketCap, the top 5 NFT collections by sales volume are Bored Apes, followed by Other Deed, Bored Ape Kennel Club, Mutant Apes, and Genuine Undead. Now keep in mind, some of these collections have very volatile prices, so do your own research. Scott Beck is the Chief Executive Officer of the United Texas Bank. And I think old Scott here might have miscalculated. I think Scott tipped his hand a bit, and I'll tell you what I mean by that in a minute. But first, let's talk about what happened. Mr. Beck has been pushing members of the state's blockchain working group. He wants them to recommend policy for leaving stablecoins and issuing stablecoins as a privilege of the banks, not crypto firms. So he was at the Texas Work Group on Blockchain Matters in Austin on Friday. And that's where he suggested limiting the ability to use U.S.-backed stablecoins to licensed banks. This would take stablecoins out of the hands of Circle and Tether, even though they're the ones who've worked and developed the whole market. To support his suggestion, Beck pointed to the work done by others. he cited a November report from President Biden's working group on financial markets. In that report, they suggested that stablecoin issuers should be held to the same standards as insured depository institutions like state and federally chartered banks. He said, quote, "If such stablecoins are defined to be money, banks are the proper economic actor to issue and manage stablecoins. Banks have the expertise and legal framework for handling money, and unlike today's stablecoin actors, banks are highly regulated at both the state and federal level." And he went on to say that he believes bringing stablecoin activities under the banking sector and keeping non-banks away from issuing stablecoins will protect customers. Additionally, he believes it will attract additional resources and capital. And then he let the truth slip. See, he was fielding a question from Robert Villaseñor when he was talking about how stablecoin issuers like Circle use non-banks to hold their assets. He's upset that they don't store their assets in banks, which tells me he absolutely does not understand crypto and shouldn't be in charge of it at all. But anyway, here's the key line here. He said stablecoin issuers like Circle were, quote, effectively sucking deposits out of the banking industry, which sounds like a win to me. Because this is pretty protectionist. They're literally campaigning the government to shut down their competitors because success hurts their bottom line. Instead of improving their product, instead of offering something of value, they want the government to step in and fix things in their favor. Now, Lee Bratcher is president of the Texas Blockchain Council, and he had a word for it. He called it anti-competitive. Now, Beck, he countered by saying that the difference between banks and private industry is simple. The cash backing the stablecoin is safe, quote, sitting at the Fed. This would ensure that funds are FDIC insured, which isn't really all that much, really. I mean, sure, for average folks, $250,000 in deposit insurance is probably enough. But as we have seen, when a stablecoin collapses, it can take a whole lot of value with it. Now, by way of comparison, Circle supposedly backs USDC with 100% value in cash or cash equivalents. This includes bank deposits, T-bills, and commercial paper. Further, they've handed over custody responsibility to BNY Mellon. 52 billion coins in circulation at present. The Texas Working Group on Blockchain Matters is a fairly new group. They were stood up in September of 2021 as a result of House Bill 1576. On their website, they list their mission as developing a framework, quote, for the expansion of the blockchain industry in Texas and recommend policies and state investments in connection with blockchain technology. And so that's going to do it for us tonight. I want to thank you, my listeners, because if you stop listening, I will stop talking. Now, a bit of a programming note. There will be no show on Sunday. I'm going away with my wife for our anniversary, so we will have a show Saturday, but there will be no show on Sunday. We will resume on Monday. Now, take care of yourselves, but take care of each other too. We'll see you tomorrow night.